Hey, good morning, everyone. Marty Mazzora here. It's Tuesday, the 2nd of September, 2025. Hope you all had a nice extended weekend. I'm going to try to keep it relatively brief this morning. I think I can be straightforward and to the point on the points I want to make. I'm going to start with the note I wrote to myself in our internal log yesterday. And I'm just going to kind of read that to you, or paraphrase it. This week's employment report will be the key data point released before the next Fed decision on interest rates, which is the 17th. Secondarily, CPI on the 11th could clearly move the markets as well. This jobs number would have to be very hot to deter the Fed at this point. I'm basing that on what futures are suggesting in terms of odds of a rate cut. While again, CPI isn't nothing, the PCE inflation indicator, which is supposedly their chosen measure, while it's above target, was not enough to sway high odds of a September cut. Our own PWA index rose notably. It improved from a negative 25.5 to a negative 18.6. Improvement in personal consumption and income, as well as the ratio between sectors and the S&P 500, meaning the more growthy or cyclical sectors were actually improving relative to the defensive sectors, which tend to denote recession. So improving means odds of an economic decline by market measures or market anticipation had declined. Heavy truck sales, on the other hand, went from neutral to negative. A net overall improvement in the data right here, all else equal, all else like stubbornly high inflation, would or should not support a rate cut, although as we sit here today, it sure looks like we're going to get one. And as I've said, notwithstanding this improvement in our index this weekend, our view is still that on balance and under the surface, the economy is weakening, and it would be okay, and I still feel that way, it'd be okay to cut 1/4 point in September. I would not get too excited, or I would not guide the market too aggressively to future rate cuts. I would say I'd want to see more data. Ironically, with regard to the employment data, another report like July's, which prompted the president to fire the head of the BLS, would actually be what the market would celebrate, as it would likely put 2 cuts on the table for September, or at a minimum, 100% seal the deal on a 25 basis point cut. So again, ironically, if indeed it's an ugly report, then I do think at this juncture, bad news is good news. If it were ugly amid other very weak on-the-ground indicators that aren't really showing up just yet, that probably wouldn't be something the market would rally on, because the market would be fearing big-time earnings disappointments amid a recession to come. Right now, I think a weak data point would probably be pretty bullish for stocks. It certainly would be for bonds. Now, despite September's negative seasonality, which is off to a real negative start this morning, which I'll talk about in a minute, my best guess is that as long as no fireworks occur around the jobs number, the equity market will rally on a Fed rate cut, just kind of repeating what I just said. One caveat would be Powell's press conference. If they cut 25 basis points, but he sounds hawkish or even decidedly non-committal on more cuts going forward, that could actually spook the market. And given generally complacent overall sentiment and the exceedingly net short VIX position occupied by speculators, and I'll show you that right here, while being very net long the NASDAQ, futures traders, spooking the market right here could make for a not small downside move in equities. We're actually seeing one this morning, which again, I'll get to. So our own very simple fear-greed barometer, which captures the price of the VIX, which is the price of implied volatility in S&P 500 options contracts, the bull-bear spread among the American Association of Individual Investors, the advisor bull-bear spread by Investor Intelligence, net futures positioning on the S&P, on the NASDAQ, and then the put-call ratio. So when it's red, it's actually, let's say, bullish for stocks, or it suggests optimism. right now may be complacency. Where it's green, that means there's some pessimism in that indicator. And right now we have a net greed score of 33, meaning people are feeling pretty good. Now, when this gets to the extreme, it tends to be very dangerous for the market. Citigroup's very popular fear greed index is now pointing to greed as well. What's really pointing to greed or complacency is the huge net short position for the VIX. So this is traders selling short the VIX, expecting it to go even lower, which means volatility to go even lower. And then here's the non-commercial futures traders net positioning on the NASDAQ 100 index, which is very, very high. And this is a 2-year chart. So you can imagine, short covering in the VIX, pushing it up. And you can see all the selling that can be had in the futures pit relative to the NASDAQ 100 index, which, by the way, is down almost 2%, which is a big one-day drop, 1.8% as I speak. The S&P is down 1.5%. The Dow is down 517 points. Clients, our core allocation is actually down just over 1/3%, just 0.35. So doing much, much better than the overall stock market. And then lastly, on my notes here, I wanted to show you the JP Morgan chart, and I've shown it in different formats, but this is something they did in December of last year. And we've talked about this over the years when the market gets out over its skis. So let's focus on the right here. These little dots on the scatter plot are subsequent 10-year returns coming off of different valuation levels. So when the S&P is trading at 11 times earnings, you can see that the 10-year average return from that point tends to be very, very good. Now, the S&P doesn't get down to 11 times earnings that often, but it does when the economy is in really bad shape. So buying there when stocks are low tends to be very, very profitable. And you can see the market, has tended to go up over time, over almost all 10-year periods, except when you come off of high price to earnings ratios. So here's where we were at the beginning of this year. And this is the forward PE. This is the projected PE for next year. So when you're here, right, these are all of the 10-year periods in history that have occurred from this valuation level. So folks, the outlook for the U.S. market over the next 10 years from a pure valuation standpoint is, let's just call it abysmal. Doesn't get any worse than this historically. Now, we're not here anymore. We're actually out over here now on the forward PE ratio. So even worse. And that plays into our thesis about where the future is going to be in terms of where the opportunities are going to be going forward. Now, it's interesting to look at it on a one-year basis, right? So in the short run, our number of one-year periods that rose off of this level, right? Number of one-year periods that fell off of this level, okay? And again, today's level is right out about here somewhere. So anyway, folks, my point is that valuations do matter. They don't matter in the short run. They are terrible timing tools. But when you're long-term investors, this is a very important thing to think about, and that is, from where do you start? And I keep saying on the charts when I show the valuations, long-term sustainable bull markets simply do not start from these levels. And this chart right here by JP Morgan proves that, at least historically. Maybe this will be the first. So obviously we need to keep an open mind, but we better not ignore history either. Okay, so quickly the charts. S&P 500 has broken down below that support. It's about to test its 50-day moving average. You probably will see the market bounce off of that, but the news could keep this thing rolling lower. Remember, very poor seasonality, and here we start September with a pretty good down day, at least so far. This panel is just something I look at once a week, but it was interesting, so I left it up. This is the on-balance volume, so cumulatively. So what this line right here does is it simply captures the up and down volume of the day. So when the line is going up or trending higher, that means we're getting more volume on the days the market rallies. When it's trending lower, that means we're getting more volume on the day the market falls. So here's the market, right, from right here, moving into all-time highs, but here's the unbalanced volume declining. Now, what that suggests is the possibility of distribution, that investors are coming in, could be institutional investors, who believe that the market is out over its skis and they're taking advantage of every rally to unload shares. And in that kind of environment, you would see down volume exceed the up volume. And that's what that hints to right here, is distribution as opposed to accumulation. And then the normal ones we look at, the momentum indicators. Again, I've been concerned about these big, long divergences, saying the market looks really heavy. When the white line drops below the red, that's a short-term sell signal on the MACD. So at least right now, for today, these are making some sense to me, and the relative strength index. As for the NASDAQ 100 index, I had drawn a potential bear flag that doesn't really look like it's playing out. I've seen technicians go too far on these, and this is what they would do. They would call this a bear flag. The actual flag itself is too long, but if that were to play out, we're going to go down a bit further right here. Losing the 20-day moving average, remember we looked at that last week. I said that's not a good sign if that continues, and it's losing the 50 right now. So not a good technical look for tech stocks right here. The dollar is rallying today. We've had quite the spike in yields today, and the dollar is benefiting from that. So we're seeing the dollar get a little bit of a lift here so far today. I mentioned yields. They're coming off the boil a little bit right here, but they're getting quite the spike. Now, I read a few headlines that tried to explain this, and I think the explanation could very well be fear that the data may not support a Fed rate cut in September. And remember, the president is working very hard to replace members on the Federal Reserve. If indeed he succeeds and gets resoundingly dovish results out of the Fed, that actually could be very inflationary if indeed the macro data isn't calling for it. So the bond market would react to that sort of thing. May also be reacting to the appellate court decision last week that the tariffs, that many of the tariffs that the White House has put on aren't legal, that the emergency measures that they invoked aren't really true to that rule. They're sending it back to the lower court. Ultimately, it could end up in the Supreme Court, which means they're still on. The tariffs are still there. But if they were to get thrown out, you could actually see a reaction in the bond market, particularly if they had to pay them back to U.S. importers. That could be quite the mess in terms of Treasury issuance going forward, and it could push yields up as well. I could also argue that ultimately tariffs are a weight on the economy and therefore they're disinflationary. And if they're gone, then that would be bullish and inflation could come roaring back and that would push interest rates higher. So lots of ways to think about this. And then gold is just really reacting to uncertainty right here. I mean, the dollar's stronger, yields are higher, and gold is going up anyway. In fact, it's breaking out of this range that I had here. In fact, actually, that range should be about right there. So that's quite the breakout to new all-time highs. That technically, the way a lot of people look at it, is very, very bullish. And it could continue, very well could. I know central banks throughout the world are buying more gold and less treasuries. That's been kind of a theme of late. But man, these are some pretty negative divergences. If sentiment changes on gold amid all of these profits, gold could take quite a hit in the near run. So something to spend a little bit of money to protect against, in my view. Long term, over the next few years, I think gold is actually going a lot higher than it is right here. Okay, so folks, I'm going to do a hard stop right there. Thank you, as always, for watching and listening, and I'll be back later in the week or over the weekend. Take care. Bye-bye.